Howdy everybody, welcome back to Accounting 1101. I'm Professor Martin. I'm here to tell you there comes a time in every accountant's life where they have to record a transaction. And that time for you is today. We are taking the training wheels off and we're going to learn how to put a transaction into the journal. Kind of our accounting diary, if you will. But before we get into that, I want to take one step back and talk a little bit about T accounts. Now, in a video way back when, we talked about the T account is simply a device that we're going to use to kind of analyze what's happening within any given account. We have the account name at the top, and of course it gets the name T account from the fact that it looks like a T. It has a left side, a debit side, and a right side, a credit side. And depending on where the number goes, debit or credit, that tells us whether the account is going up or down. Remember back to our conversation when I tried to brainwash you and tell you forget everything you know about debit and credit. All debit means in accounting is left. All credit means is right. So depending on where we put the number, left or right, is telling us whether the account is going up or down. We had a little bit of memorization we had to do. I told you all it'd be a good idea to print off the graphic you're looking at right here. These are the rules, all right? On an asset account, a debit will make the account go up. A credit will make it go down. On the other side of the accounting equation, our liabilities, a credit is going to make a liability account go up. A debit will make it go down. You can see all the different rules right there. And I told you all, be sure you print this off so we can refer back to it. Now we're going to need to know the different rules as we start to make transactions. So hopefully you've got that printed off and you got that handy. We have also talked about how transactions impact the accounting equation. If you didn't look at that video, make sure you go back and review that and do the reading in the book so you understand how the transactions we make impact the accounting equation. I'm going to be pulling in that information for every transaction that we can do, just to kind of review it as we go along. But our focus, our burning intense focus on our video right now is going to be using a journal to record transactions, because that's where it all begins. Our entire accounting process begins with putting transactions into the accounting system via a journal. So, what does the journal look like? It looks like this right here. And of course, you know, if we're talking about a computerized environment, it might not be laid out exactly like this, but the basic idea. We have an area for the date. We have a date column. We have an area to write out the accounts involved. We have an area to write down the number, the debit and the credit. So when we fill out the journal, it's going to look like what you see right here. And two sample transactions I've thrown up, you can see. We have a date. We have two accounts involved in that transaction. We've got the amount. And then at the bottom, I've got a description, a narrative talking about what the transaction is, what happened. Underneath that, the exact same idea, but you see on that one, we've got two accounts that we've debited. That's okay. I can have 40 debits and 27 credits. The number of accounts involved doesn't matter. What matters is we balance debits equal credits in dollar amount. And you can see right here, we've got 5,000 on the debit side. We've got 5,000 on the credit side. That balances. We're okay. So we can have multiple debits and multiple credits. No big deal, as long as the amounts balance in dollar amounts. A couple other things you're looking at formatting wise. You'll notice we've got our debits listed on top and then the credits listed on the bottom. Indented. Makes it easy to read and follow when we're looking at multiple journal entries. Okay? So, we've got one date per transaction. We've got our debits on top. We've got our credits underneath, and we're going to indent the credit line so it's easy to read. Right on. Very simple. Hard part is knowing what to put in there. So, just to summarize, journal entry formatting, we always include one date per transaction. The debits always are going to be on top, on the left margin. The credits will be after the debits, and we're going to indent those a little bit. We will have always at least one debit, maybe more. We'll always have one credit, maybe more, but we'll always have at least one debit and one credit. The dollar amounts of our debit is always going to equal the dollar amounts of our credits. At the very bottom, we'll write a little description, and then we're going to skip a space. Make it easy to go to the next one, make it easy to read. So we're going to record 12, count them, a dozen transactions here. You can see them listed out. We're going to walk through every one of these. I'm going to show you how to record them in the journal. Again, we're going to refer back to our little cheat note here, so we know what makes the account go up, what makes the account go down. Are you ready? Here we go. The way I've designed the presentation, you can print off the presentation, the notes, and you can follow right along. You can either try it ahead of time, check yourself against my work, or you can just write along with me. I think there's really something to writing stuff out. So I want you to write out your notes, keep it in your notes, and we will have those to refer back to later on. Transaction number 1, January 3rd, 2019, issues 20,000 shares of common stock for cash. Again, we're analyzing transactions. We kind of have to do two things. First of all, we have to figure out what accounts are going to be in play. Right? We got to figure out what accounts we're using here. The second thing we have to do is we have to figure out whether the accounts are going up or down. Then finally, the third thing we have to do is figure out, well, is it a debit or a credit that's going to make that account go up or down? So, task number 1, job number 1 here. What accounts are in play? Well, we've got a cash account. We've got common stock. Issues common stock for cash. Cash is coming in the door. We've got a cash account in play. We got a common stock account in play here. We got two accounts going on that we got to deal with. Do the accounts need to go up or down? Cash is coming in the door. We're getting money. So cash needs to come up or go up. Exact same with common stock. We've issued common stock to the investor to show that they've invested. So common stock needs to go up. We got two accounts and they both need to go up. Well, that brings us to step number 3, debit or credit. So here we go. That's where we're going to refer back to your little sheet there where we got them all listed out. January 3rd is our date. Our cash account is going to be debited here because debits make asset accounts go up. Write out cash. We're talking 20,000. Then our common stock is going to be our credit. Common stock needs to go up. And if we want to put a little description here at the bottom, issued stock. That description tells people what's going on in the transaction. Now, you'll get to the point in your accounting career, maybe it'll hopefully happen sometime during our semester together, where you can just look at the debit and credit and know, okay, cash is coming in, common stock is credited, so we issued stock for cash. You'll be able to look at the transaction and know what happens without reading the description. You'll get to that point. But for now, we'll go ahead and throw in that description. Cash, debit, common stock credit. Notice I've got the second line, the credit line, indented. Makes it easy to read. I only need one date. I didn't put 1, 3 on every line. Don't need to do that. I need one date. So, the impact on the accounting equation. Assets goes up $20,000. Equity goes up $20,000. Now, if your mind is blown, if you watch me breeze through that and you're like, how in the world did you know to debit cash? How did you know that common stock was the credit? Okay, I identified the accounts. I figured out whether they needed to go up or down. I have the third part, debit and credit, memorized. If you don't have that memorized, this is where you refer back to that little graphic. Okay, you know we have a cash account. You know that's an asset account. To make it go up, I need a debit. You know we have a common stock account. That's an equity account. To make it go up, I need a credit. Debits equal credit. Accounting harmony has been achieved here, right? So, refer back to that again until you have everything memorized. Moving on along to number 2. January 5, 2019, we bought equipment on account for $3,500. Payment due within a month. Remember back to our video where we talked about analyzing transactions in the accounting equation. You hopefully remember when we talk about buying something on account, we're talking about an account payable. It's a liability, isn't it? We owe money to a vendor we bought stuff from. We bought equipment. So our 2 accounts in play, equipment and accounts payable. They both need to go up. We have more equipment. We also owe more money to that vendor. So 1.5. Our debit will be to equipment. Assets go up on the debit side. $3,500. We need a credit. Accounts payable. Liabilities, like accounts payable, go up on the credit side. For the description, we can just say bought equipment on account. There you go. You'll notice we don't need to put any numbers on that description line. We also don't need to put a total for the journal entry. Now, sometimes I see people when they make journal entries, I want to draw a line here and write a total. You don't need to do that. Just put in your debit, put in your credit, wash your hands, and go on about your day. All right? So, how does that impact the accounting equation? Assets went up $3,500. Liabilities went up $3,500. Just like that. Number 3. Remember, we got 12 to go. So we have a flurry of accounting activity. We're only at the beginning here. On the 3rd, January 9th, we got $4,000 cash in advance from a customer for services not yet rendered. We took their money, haven't done anything for them yet. So money, cash is coming in the door. Cash account is in play. When we take a customer's money, but we haven't done anything for them yet, we have unearned revenue. It's our second account in play here. You might remember that is a liability account. We owe that customer either a product, a service, or we need to give them their money back if we can't provide it. $4,000 coming in the door, so cash needs to go up. The liability needs to go up to reflect the fact that we've taken money, haven't done anything for them. How do we make that happen? Put the date in. Cash account, we already know, goes up on the debit side. Unearned revenue goes up on the credit side. And liabilities go up on the credit side. $4,000. And for a description, we can simply say took cash, services to be performed. Whatever kind of description you want to put in that tells you what's going on is fine by me, as long as it makes sense and matches the transaction. Here's our impact on the accounting equation. We know we took in money, took in cash. Our assets go up $4,000. Our liabilities go up $4,000 as well. Number 4. Again, hopefully you're writing these out along with me. You've got this printed off. If you don't have a printer at home, hey, grab a sheet of notebook paper. It's the exact same thing as far as I'm concerned. January 10th, 2019, we provided $5,500 in services to a customer who is going to be billed. They are buying now, they are paying later. So no cash involved here. We're not taking any money right now. What we got is something called an account receivable, an asset. They owe us money for what we've already provided. Well, what we've already provided, service revenue. We've done the work. We can count that revenue. So, account receivable, asset, it needs to go up to reflect the fact that we are owed money by that customer. Our revenue account needs to go up to reflect the fact that we've done the work. We've earned the money. 110 is our date. I got accounts receivable. 5,500. And we got our revenue. We've earned it. We're going to count it. Bingo. There we go. What's our description? How about sold services on account? Looks pretty good, right? So there we go. We have a customer who owes $5,500 after we have done the work for them. How does that impact our accounting equation? Take a look. Assets go up $5,500. Our equity goes up $5,500. Remember, when we have revenue, that increases our equity. When we have expenses, we pay our employees, we pay the utility bill, we pay for supply, whatever the case might be. Our expenses go up and our equity goes down. How about an example of that right now? Talk about timely. On January 12, we pay $300 for a utility bill. We pay in cash. The electric company does not like to take a hug or an IOU. You can't send them a fruit basket. We got to pay them in cash. All right, so we got the cash account in play here. And then we have a utility bill we're paying. So we have something called utilities expense. We have an expense. Utilities is just describing what the expense was. We could have wages expense, salaries expense, cost of goods sold expense. We could have all kinds of different expenses. Expense tells you the thing that's going on. The first word is the descriptive, what kind of expense it was. Utilities expense, wages expense. So cash needs to go down. We paid $300. Cash is going down. Our expenses are going up. Let's go ahead and put in 112. Whenever we record an expense, it's always going to be a debit. Expenses are always debits, y'all. Only time we will credit an expense account is if we've boogered something up and we got to fix it, or we're closing out the account at the end of the period. We'll show you that later on. But for now, anytime you're trying to record an expense, you better be putting it on the debit side. Cash is going down. Assets go down on the credit side. Paid utilities. There we go. Expenses to debit, cash credit. How does that impact our accounting equation? Well, assets are going to go down. Boom. Assets go down $300 because we paid cash. We no longer have that $300. Our equity is going to go down $300. Remember, expenses make retained earnings. Our equity go down. So even though the account itself is going up, the utilities expense account is going up, it's going to have a negative impact on our equity. It's going to make our retained earnings go down. I'm going to show you the process where we put that account balance from our expense account into retained earnings and equity in another chapter when we're talking about closing accounts. But for now, just be aware, Expenses are going to reduce our equity. Next up, halfway through after this one, transaction number 6. On January 14th, we distributed $100 cash in dividends to our stockholders. We got a cash account going on and a dividends account going on. Dividends are kind of like expenses in the fact that they are going to lower our retained earnings and our equity. So our cash account is going to go down. Dividends that have been paid, our dividends are going up, but it's going to reduce our retained earnings and our equity. So we're going to treat it kind of like an expense here. 114, our debit is going to be to dividend. Dividend, again, is simply the company paying back some profits to the shareholders. Cash account, $100. Our description, paid dividends. So we're about halfway through, and if you're kind of worried at this point, if you're looking at these transactions and you're thinking, how in the world am I ever going to keep all of that straight? Here's the beautiful thing about accounting. Accounting is a game of doing the exact same thing over and over and over again, y'all. It's like that character in Greek mythology. I can't remember the guy's name. But basically, the guy was doomed for all eternity to roll the boulder up a hill. And then it rolls back down, and he pushes it back up. The same thing over and over. If you can remember that cat's name, let me know, because I can't remember for the life of me what that guy's name was in Greek mythology. But it's the same idea in accounting. These transactions don't change. Once you learn how to do it, it's the same thing over and over and over. So that's why it's so important for you all to keep good notes, because you can refer back to your notes if you forget how to do a transaction. We talked in the one video, double entry bookkeeping is 500 years old. These transactions haven't changed for 500 years. All right? They're not changing anytime soon. So if you don't have them memorized, you can refer back to your notes if you have good notes like we're doing right now. With that rent being over, here's the impact on the accounting equation for that transaction. Assets went down 100 from where we paid cash. Our retained earnings underneath stockholders' equity go down 100 from where we paid dividends. All right. Number 7, how about a new transaction? On January 17th, we got $2,800 in cash from a customer for services that we have provided. Customers paying cash, we did the work. So 2 accounts going on here. We got our cash account and our revenue account. We did the work. We can count the revenue. Both accounts need to go up. January 17th. Happens to be my dad's birthday. Shout out to Pops. And January 17th, happy birthday. Cash account needs to be debited to make that account go up. Revenue is a credit. Kind of like we talked about with expense accounts a moment ago. Revenue accounts are the opposite. Revenue accounts are always going to be credits when we enter the revenue. The only time we're ever going to debit a revenue account is if we boogered it up and we need to fix it, or we're closing it out. So keep that in mind. Right now, when you see a revenue, we need to book a revenue, it's always going to be a credit. Expenses are always going to be debits. Revenues are going to be credits. I'll just say for a description, performed services for cash. Customer paid in cash. We like people that pay in cash, don't we? The effect on the accounting equation, our cash account, assets go up, equity goes up. Revenue makes retained earnings and equity go up. Moving right along, number 8, we paid cash for the equipment we bought on January 5th. If you remember, on January 5th, we bought equipment. The vendor said you can pay us later on. So we are paying what we owed. If I remember correctly, we owed $3,500 on that equipment. Now we're here to pay it back. Cash accounts involved. We are paying money. We are paying in cash an amount we owed. You remember the amount we owed was called an account payable. Cash is going to go down. The accounts payable is going to go down because we're paying it back. 118. Accounts payable, liabilities go down on the debit side. We got what? 3,500. Cash is our asset account. Cash goes down on the credit side. Our description, real simple. Paid accounts payable. Boom. Easy peasy. How does that impact the accounting equation? Assets have gone down 3,500 from where we paid cash out the door. The account payable has gone down. So one side goes down, the other side goes down. Moving right along. Number 9. On January 20th, we paid $3,600 in salary expenses to employees. So we have our cash account involved. And we have a new account, salaries expense. Again, we already know how to handle an expense account. Salaries is just describing what the expense was. We could have 1,000 different expense accounts. The first word is describing what the expense was, what the nature of it was. In that case, we have salaries that we had paid. So, 120. Cash account needs to come down. I told you before, expenses are always going to be debits unless we boogered it up and are fixing it or we are closing it out. Just recording an expense, it's going to be a debit. 3,600. Cash goes down. 3,600. I'm just going to say paid salaries is my description. Now you might look at that and say, well, wait a second, Professor Martin. You know, I work for a living. I'm out there making it happen. I know when I get my paycheck, not only is my salary on it, but they've taken out all kinds of taxes and withholdings and all that garbage. Where's that in the journal entry? I like your style. You're about 4 weeks ahead of me. All right, we're going to get to that. I'll show you how to take care of all the withholdings and all the taxes and that kind of thing later on. For right now, we're just going to make it easy. Salaries expense. What about the impact on the accounting equation? Assets have gone down. Cash went out the door. Equity has gone down. Retained earnings have gone down because we had an expense. Number 10, double digits are upon us. We're getting near the end of the month too. January 23rd, cash payment in full from the customer on the January 10th transaction. You might remember we sold on account. We did $5,500 worth of work for a customer and said, hey, we trust you. We like the cut of your jib. You can pay us later on. So they're going to do that. Now has come time. They've paid $5,500. So when we sell to a customer on account and we say, we'll let you buy now and pay later, that's called an account receivable. Remember the key word there, receive. We expect to receive money at some point from that customer or from the bank if we're talking about like interest receivable. The other account, cash, they're paying us. Cash is coming in the door. All right, so let's go ahead and put that in. Cash is going up, $5,500. Account receivables going down. The customer doesn't owe us that money anymore. They paid. So for a description, I'll say collected cash on account. Customer owed us money. They have paid us back. Notice I didn't count revenue. This has nothing to do with revenue. We counted the revenue at the time of sale, right? If I count revenue again, we have a fancy word for that in accounting. It's called fraud. That's the kind of thing you go to jail for. Double counting revenue is a big no-no. We don't count revenue here. already counted at the time of sale when we did the work. So all we're doing here is taking away the amount the customer owes and collecting the cash. Interestingly enough, the impact on the accounting equation, you'll notice only one side is being impacted, right? One account goes up on the asset side, the other one goes down, accounts receivable. Nothing happens in liabilities or equity. So it kind of washes itself out on the asset side. Sometimes that happens. Number 11, on January 27th, we provided $1,200 in services to a customer who wants to be billed later on. We run the credit check, we did the background check, and they are credit worthy. We're going to go ahead and let them do that. So again, when we sell to a customer and let them pay later, accounts receivable. We expect to receive that money at some point. Our other account here, we provided the services, we've done the work. So we count the revenue. Just like expenses. Service is a description. What type of revenue? Service revenue. Maybe it's sales revenue where we sold a product, sales revenue. Maybe it's interest revenue where we earned money. Maybe it's rent revenue where we rented a building. Whatever the case might be, that first word is describing the kind of revenue. All right, so the asset account needs to go up. Receivable, customer owes money. Hopefully they pay. We'll talk about later on what happens if they don't pay and how to handle amounts that we estimate might not be paid back. Because that happens when we sell on credit. Sometimes people don't pay and we got to make an accounting for that. All right, so for a description, sold services on account. On account. There we go. The impact on the accounting equation. Accounts receivable, asset, it goes up. Our equity via retained earnings goes up because we have revenue. One more. Hopefully you're still with me. 1/30/19. Bought supplies on account. Payment is due in 90 days. When we buy now and pay later, we call that an account payable. Again, the key word there, payable. We have to pay somebody. We bought supplies. Supplies is an asset. We can throw them in the closet and use them to operate the business. So our debit is to that account supplies, 500. Credit to accounts payable. Accounts payable, liability goes up on the credit side. For a description, bought supplies on account. So there we have it. The impact on the accounting equation, real simple. Assets have gone up because of the supplies that we bought. Liabilities have gone up. We owe a vendor $500. So put it all together. We look at the transactions in the journal back to back to back. You can see all nice and neat, laid out just like I did, only the type where you can actually read them instead of my chicken scratch on the screen there. And you'll notice we put a blank line in between every one. Makes it easy to read. One date, debit on top, credit on the bottom. The credit is indented to make it easy to read. Then we have our description at the bottom. Wonderful, perfect journal entries. Gotta love it. Our next video, I'm going to show you how to take the journal entry transactions and post them over to the ledger accounts. That way we can have a running balance and know how much is exactly in the account at all times. I'm also going to show you how to calculate that ending balance in the ledger accounts. So we're not quite done yet. Another step or two in this beginning process. As you're looking at the videos, as you're doing the reading, as you're trying to complete the homework, if you have any questions at all, reach out to me. Very important to reach out in the early part, because what we're doing is we're building the accounting foundation. If you've ever seen a house being built, you build the foundation, you lay the concrete basement or the crawl space with concrete blocks. And then you put the subfloor in to build the walls, you build the roof, right? If you don't have a good foundation, everything collapses. It's the exact same thing here. Right now we're learning the foundation. Later on we're going to build up. If you don't have a good foundation in the fundamentals of debit and credit and bookkeeping, then it's hard to build up. Everything will collapse. So very important in the early going. Make sure you understand what we're doing. If you don't, holler at me. I'll take care of you. We'll walk through it. We'll get you where you need to be, but make sure that you do that in the early going, because you don't get caught up later on if you get lost at the beginning. It has been my experience. Long video. Hopefully you got your notes. Hopefully you made it through. Go get yourself a reward, some ice cream, a Mountain Dew, some Taco Bell, whatever you need. I'll be here waiting until next time. Take care, everybody.